Pessimists sound smart, but optimists make money. I just want to get that in because I can sound like a pessimistic badger, but ultimately I am an optimistic Luke who believes in like a good future for everybody.
I don't want to go too deep in the weeds, but in the sense, in the way I'm using it, the philosophy from which you live colors everything. And often, when unexamined, you do things a certain way, but you have no idea why you do things that way.
Focus on the business metrics, not the share price. And it's like, follow the owner of the dog holding the leash, not the dog that's running all over the shop, because they're going to end up in the same place. And that the owner is walking like a steady path.
Well, this stuff is why I built the Investor's Mirror app, which is forcing yourself to go through slowing down and reflecting on your own internal character is my word for it.
For an advertising-free version of this show, check out wallstreetwildlife.com.
Welcome to the Deep Investing Jungle with your hosts Luke the Badger Hallard and Krzysztof the Monkey Piekarski. This week on the show, Krzysztof is telling us all about his King of the Jungle stock, Amplitech. And I'm getting into the mud with Palantir. But also, we're chatting philosophy.
Philosophy, Badger, what is philosophy?
You're the professor of philosophy, man. You tell me.
Actually, you know what? It's funny, most people default to love of wisdom because that's how the word actually breaks down etymologically. But the way I understand it is it's like the thing you do as a practice to reframe the lens through which you see the world, which is, it's like the creating of schemes and concepts that can refracture the world so that you understand it in a very different way. And it's for investing, it's incredibly important because you could, as one example, a value investor has a certain filter on the world, right? A certain frame through which they see the world. A growth investor has a very different philosophy, filter, view. A dividend investor has a certain, framework and philosophy isn't exactly the same thing, but close enough.
Yeah, that makes sense. I think of them as like my philosophy of investing as like principles and like rules that I will break sometimes, but at least I know I'm breaking the rule as opposed to doing it. But yeah, what you say is right. Like, naturally as humans, we're drawn to, we have a certain risk tolerance because of maybe formative experiences. And then we're drawn to, as investors, we're drawn to different parts of the market, perhaps.
I don't want to go too deep in the weeds, but in the sense, in the way I'm using it, the philosophy from which you live colors everything. And often, when unexamined, you do things a certain way, but you have no idea why you do things that way. Let me give you a very, very maybe applicable example. For somebody, money might be the most important thing in their life. So as investors, let's say that's the goal, then they keep chasing just more and more money. But somebody could be an investor with a different philosophy, like I think you and I are, where it's not exactly money that's the issue, it's time, or time spent. Same, you still buy and sell stocks, but the place from which, the method from which, the why in which we do it, the endpoints of success are potentially defined very, very differently. But you have to examine it.
Are you happy with who you are as an investor, do you think?
Right now? No. I'm a disaster right now. Maybe it's because at the moment all of my top holdings have been completely decimated, so it's hard to feel great about.
Maybe you changed your approach a couple of years ago and you're still in like the uncomfortable kind of new mode. But if we just look at your King of the Jungle portfolio results, which are transparent, we haven't messed with anything. It's all there at wallstreetwildlife.com if you want to check it out. Like in year one, you lost money. You didn't even underperform the market. Like you lost money. In year two, you delivered like a 380% return, something absolutely insane. And now we're in year three and you're underperforming again. But you only, if you only get like a 300% return every like 3 years, you're still winning. Like you are winning the contest, even though I'm like Mr. Slow and Steady every year.
Yeah, but right, we started talking about philosophy. I made the switch from the kinds of companies you still invest in to a much more murky backwater, difficult, I would say, form of investing, which creates a lot of turbulence, both in terms of the volatility of results, but also internally. When I have to look at some of the companies I own, for the reasons that I own them, I sometimes salivate. I'm like, if only I owned CrowdStrike, if only which is a fascinating thing to say, because it's not like I'm blind to my former life. So anyway, it's a time of transition, and it's hard. Transitions are hard and messy.
Well, I haven't changed my approach. It's evolved and matured over probably what's coming up to, I think, 23 years as an investor. I think my investing birthday I'm calling August, although it's a bit hazy when it actually was. But the reason we're talking about this topic is I got a question on X from Sidecar Investor. Check him out. Like he posts a whole bunch of interesting stuff. We follow each other. And he said to me back in May, is there one article or interview that best outlines your investing approach? So it's taken me like a couple of months to get this on the docket and like review 23 years of history and validate what I thought about myself. But I did that with the help of AI. And I think I've got like my rules, my principles down, and I thought I'd talk about them today. Sound good?
Yeah. Okay. School me, Socrates.
Yeah. This is like the roadmap I work to, which has evolved. This may not be right for you if you're listening. Certainly not right for Krzysztof. It all comes down to, essentially, I stole this phrase from you, know the game you're playing. Like if you think you're a growth investor, but you're actually invested in like boring dividend companies, or if you think you're like super stable and you're just trying to like beat the market by a little bit or deliver a market return, but you've got like a load of wild options, or you're trading in and out and you think you're a long-term investor, like don't fool yourself. Have an approach and have a process. And I always used to say, I still say, like the keys to becoming a better investor are have an investing process and then have a process to improve your process. And like the improvements compound. Like if you make 1% better decisions every month, every year, that's going to compound and you're going to become a better investor over your lifetime. But let's get into some of the nitty gritty. And I've got a nice pretty picture here if you're on the YouTube, but if you're not, check it out on Wall Street Wildlife. I'll post it as a free article. And let me just talk to it. So like, what is the game I'm playing? Like everything starts with owning what I consider to be world-class companies shaping a better future. And another way I sometimes say that is like buying companies that are producing products and services that the world is going to need more of in like 10 years time. And I know that this do challenge me on this shaping a better future, because I'm talking about Palantir in today's episode. And like, I can make an argument for that, but it's right that I get challenged on that one quite frequently as a holding. But that's my principle, buying great companies that are making the world a better place. Also, I just hold for a very long time. Like I have calculated my average holding period. It's something like 37 months, I think. Like it might change, and I probably traded a bit more frequently since I no longer work for like a bank that has a compliance process. But I do try. I certainly buy with the intent of holding for a long time. And the shape of my portfolio has a pretty somewhat concentrated core. So directionally, I'm trying to personally get to 75% of my money in a top 15 set of stocks. And then I'm happy to have like a venture tail. Basically, like, let's say my core, the main allocation is like the top 15. I'm happy to have like another 15 that are much smaller positions. And, there might be companies like ASTS, which we're planning a 7-hour episode on in the coming weeks. Like, we're working on it right now. I promise it's coming. But like tiny little random companies that might be like a core in the future. But I'm happy with that as a shape of the portfolio. And then the idea is I'm trying to beat the market. Like, I'm stock picking. I only own one ETF. I'm actively picking stocks. Like, that ETF is like a 1% allocation. It's immaterial. And my goal is to beat the S&P. The S&P typical return is about 10%. The NASDAQ long-term return is something like 16 or 17%. I'm delivering 20 to 23% per year over what will be 23 years. So, input is process, output is hopefully the CAGR.
Yeah, those are stupendous results. My first pushback, if you want to even call it that, is to some extent all investors are, for better or worse, involved with lady luck. And it is possible, I think, just like at the poker table, where you have a good process, you have these same principles, but for all the reasons that we know, known knowns, known unknowns, you invest in 7 companies and you never hit that, intuitive surgical or the Palantir or the whatever. And then because you default to not trading, especially in today's rapid change, your company is made obsolescent. So at the same time, we know from playing poker, the longer you sit at the table and your results are what they are, the luck factor is harder and harder to say, oh, it was just luck. That's obviously not what I'm saying, but there is a downside, as we know from my options course, to the long-term investing strategy. And I think if I could speak on your behalf, you're both very skillful. You followed the process with discipline, and you had the cards fall your way early on that you then took advantage of. I don't know if that sounds fair.
No, that's totally fair. Like, I still challenged myself. Like, I've definitely had periods of a couple of years over the 23 years where I've underperformed for like 2 or 3 years at a time. And maybe most recently, 2022 was definitely one of those years. And maybe 2023, like, I just underperformed the market. But I've certainly had like 3-year runs. And I do question myself, like, am I just like the lucky badger at one end of the bell curve? For every lucky badger, there's like 1,000 unlucky badgers who are roadkill, maybe. I suppose as time wears on, if I can do this for another 23 years, there's probably a few more sigmas of confidence that I'm actually doing something smart. Anyway, let's plow on, because there's a bunch of other stuff in here I want to talk about, and I don't want to spend the whole episode on this. So, like, the next thing in my framework is, I suppose, what I'm calling 3 skills. It's kind of where you focus your time. So in my mind, there's like 3 things you can be thinking about as an investor. There's like managing yourself, your emotions. There's managing the portfolio as a whole, like a collection of stocks. And then there's actually the stock picking. And I think it's a bit counterintuitive. We said this many times on the pod. Most people spend like 90% of their time on stock picking, doing research and maybe creating DCFs and trying to figure out what's like a market beta investment. But actually, in some ways, that's the least important of these 3 things in my mind. Like, probably more important than stock picking is portfolio management. Because, if you have like an incredible market beating investment, but you only have a tiny allocation, like, so what? And if you have what you think is a great company, but it's wildly volatile and you have too big a allocation, then you could, you could suffer a couple of years of drawdown. That could really set you back. So portfolio management, I think, is incredibly important and helps you with your stock picking because it helps you be a bit more resilient when things do go a bit crazy for a couple of years. But more important than portfolio management, the most important thing is managing yourself, in my mind. This is like foundational, well, stuff you and I talk about all the time. I know you agree with this. And it's like managing your own emotions, not letting fear or greed or envy or some other, something that comes from down here. I'm pointing like at my chest and I guess at my groin. like some physical thing like that drive your investment decisions. I try and be from the head. And there's a bunch of tools I use, which I'll talk about in a sec, that allow me or help me like navigate it from a place of, what's that? Who's the chimp brain and the other brain? Like this is your expertise. But, I try and definitely suppress my chimp brain with like my higher mind.
Yeah, well, this stuff is why I built the Investor's Mirror app, which is forcing yourself to go through slowing down and reflecting on your own internal character is my word for it. And it's amazing how effective it is if you can get yourself to do it. Most people don't, and then pay the consequences. The analogy I have for these 3 steps, I was thinking in terms of an artist or painting a painting, and it seems like self-management is the artist. Like, what kind of artist are you that in turn creates the kind of painting you're going to paint. But obviously you need a canvas of some shape and size. If it's too small, it's going to not, you can't really paint on it or whatever. And then the actual colors themselves are the stocks, almost, in terms of sequence. I don't know if that's useful at all, but no painting without a canvas and artist, that's for sure.
Yeah. Or we're sculpting, we sculpt our portfolio. We try and, do it diligently, because I guess if you chop away the wrong bit of rock, you've got to start from scratch.
What else do you want to test? Yeah.
So let's go a bit deeper into the graphic, because I said, managing myself, managing my emotions is a really foundational part of how I operate. So I do have some rules that I follow that help me do that. And every rule has an exception. I've broken these rules, but here they are. Default to inaction. Most of the time, when you think the right thing to do is to buy or sell or trim or add, most of the time the right answer is actually do nothing. I used to play a lot of Street Fighter 2 as a kid, and my main Street Fighter character was Ryu, with his Hadouken. If I think about my own special combo as an investor, it's press no buttons, do nothing. That's my special combo. Hadouken, the market. Hadouken, the market. I will never, or very rarely, again, rules to be broken, I'll never fully sell a position unless the thesis is broken. So, if the valuation is insane, like Axon was and Palantir probably is, I definitely trim, and I'll trim it way, way, way down to a 0.5% allocation. I'm not going to sell out completely. But if the thesis is broken, I'm out the door. And that happened to me for Wise, the TransferWise, the money transfer folks, quite recently. And I think the thesis could repair itself, but for the moment I'm out because there's this regulatory issue. I have a hard cap. It used to be, this is portfolio management, but it helps me sleep at night. If I have any allocation that's more than 15% of my total portfolio, which in essence is my total net worth, then I'm into a mode of trimming, looking for opportunities to take some money off the table and build some cash, because just too much allocation. And I'm retired essentially, apart from this podcast, and I live on the portfolio month to month. So if I have no more than 15% exposure, even to an incredible company like Rocket Lab, if things go bad, then it can't hurt me too much. And it used to be 20%. It's now down to 15%, driven by I think I'm less resilient to volatility now in my 50s than I was in my 40s. And then, like cash, I mentioned cash, but I do keep like a cash pile. It's kind of an emotional hedge. And I say cash, like the cash is in short dated gilts and money market funds and stuff like that. So it's still earning like 3.5%, 4%. It's kind of treading water against inflation. And the idea isn't about having like massive cash allocation to time the market, although there's a little bit of that. It's about having like a baseline cash of say 5 or so %, which is enough actual money to pay the bills for a couple of years. So then if things really go to shit, I'm not going to be destitute and have to like sell the house. But I'll flex that up. Currently my cash allocation is 23%. That's too high. It probably should be more like 20 to 21%. And the reason, I think 21% is about the right number is the market's quite expensive at the moment. Things feel somewhat fragile still, even though the market seems to be like an unpoppable bubble. But that, I think if things go bad, they could go bad fast. So I want a bigger cash allocation. When we're at the depths of despair in 2022, my cash allocation was down to like 6 or 7%. So, I do flex it. So sort of give myself more dry powder when things might go on sale. I guess that's kind of the driving thought there. Anything on that just before I finish off the graphic?
Yeah, I know not having enough cash is an error I've made consistently throughout my career, because we're both in the market, I always want it deployed. I mean, I never truly integrated cash as a position itself mentality, and it's something I'm getting better at. In my King of the Jungle right now, I have, I think it's my number 5 position, but historically speaking, I could really attest to that as a strength. Often it makes a lot of things better. The sleep quotient, and then actually, I don't know if you said this explicitly, when things go down, you actually don't just despair. You start getting interested, and it's a counter, right? It's a counter antidote if your cash is high enough.
That's exactly it, right? Because I try and balance my cash because it's so that I balance my emotions. It's exactly as you said. If the market sells off like 50% tomorrow, obviously that's not going to happen, but extreme examples help you understand your decision making better. If the market sells off hard, I'm like, great, I've got a load of cash which I can redeploy at cheaper values. So always like you try and incentivize yourself to celebrate big drawdowns. And and when things are up, like great, and I always want to kind of balance my cash so that I'm emotionally neutral whichever way the market goes. It's kind of my principle.
Yeah. This is just a little self-reflection here. I don't know if it's useful for anyone, but as a professional, I've been an educator. From being a high school teacher out of college to a grad school graduate student for 8 years, which is poverty level, to finally teaching at the university level. But professors, educators do not make a lot of money. And so I have never had massive influxes of cash. It's mostly been through consistently being invested that my net worth has, increased. But that's also sort of the counterpoint. In as much as I want to have cash, it's the fact that I've invested fully most of the time that has also been a benefit, but it had, the live by the sword, die by the sword kind of thing. So I mention that just because people have different lives. If you have a large cash influx, it's probably easier to maintain a larger cash position than if you don't. So it's always complicated. I mean, there's so many variables you have to tend to.
The last few kind of tools and techniques that make this easier for me if I'm in a big drawdown like I was in 2022, I try to think about my drawdown in days, not dollars. And this is actually surprisingly powerful. Let me explain what I mean by that. Like I was sat on, let's say, my Google position, right? And Google was down in peak pessimism in 2025, I suppose, about a year ago, maybe a little over a year ago. And I was never really in the red with that, but I was definitely down from a peak with that position, or my portfolio as a whole. And I could look back and go, well, if I look at this position, I was at this like amount of money. Maybe I've lost, let's put a real number on it. Maybe I'm down like $200,000 or something on a position. But I can go, well, actually, if I wind back the clock, 6 months, then it was worth the same amount that it is now. So if you can force yourself to think, I'm not down this money, I'm down this amount of time, then the time seems more recoverable. And as the numbers get bigger, like the time still kind of stays relatively the same. So in the depths of like drawdown of 2022, I could have been pulling my hair out and said, like, Christ, I've retired from having a job and I'm down like 40% overall. Like my life I could have thought about my life being like wiped out. I was down a big dollar number for me at the time. But instead I focused on, well, I'm back to the valuations of late 2020. All I've done is I've lost like a year and a half. It's only a year and a half. How bad is that? Right? And it just became something easier. And it took a long time to get back to that 2020 valuation. So in the end, I lost, 3 or 4 years. But that is the nature of being like a growth investor. You are going to experience bigger swings. So I found that surprisingly powerful. Sleep is quite an important metric. Like if I wake up in the night thinking about a position, I probably own too much. Simple. So that's just like a good personal guideline. I should probably trim it. I might sometimes wake up and think, oh God, I don't own enough Google. I don't own enough Palantir. Buy more. The world is going to shit. Buy more. So again, like this, your subconscious can be quite a powerful guide. Don't track the stock price. Don't focus on that. That's the output. Focus on the company metrics, the fundamentals. Ideally, you have like a preferred valuation metric for a company, and they'll be different for different companies depending on their maturity. Know the valuation, know the key metrics within that company that are driving progress, and you can monitor it against, like for Tesla, we talked about last week. Maybe it's like Model 3 and Model Y deliveries. That's now inflected. So now they're delivering more cars than they were like the prior quarter. So that's probably a good sign. People have got over like Musk horror. Focus on the business metrics, not the share price. And it's like, follow the owner of the dog holding the leash, not the dog that's running all over the shop, because they're going to end up in the same place. And that the owner is walking like a steady path. That's your business metrics. And then something I've introduced into my framework relatively recently, the last year or two with you, is be able to articulate the bear case. So, like for every stock I own, I want to be able to explain it to like my mom in 1 minute, simply, this is what the company is and what it does. I also want to be able to explain off the cuff, like this is the bear case, this is what can go wrong. I think if you really understand that, it makes you more aware of the things that can go wrong and you start looking out for them. So I think that's powerful. I'm just going to blast through the rest of this graphic just to kind of close it out, just in case you're not on the YouTubes. I don't do price targets. I don't think they're useful. I know you use a lot of technical analysis alongside fundamental analysis. It ain't for me. I definitely don't do copy trading, and I stay away from opportunities to put out my portfolio for other people to copy it. I know we share our investment decisions in real time at wallstreetwildlife.com on the Patreon to our dolphins. I don't encourage people to follow us and do the same thing we do. And I don't invest in active funds, just like I talked about last week on the pod with Fundsmith. You can see outperformance from time to time, but in the round, they're going to underperform the market. And I try not to invest in sectors where I don't think I have an edge, fashion or something. I would say like retail, but I own Greggs. I don't think I have an edge in Greggs. I own it for a slightly different reason to do with income. I try and focus on the stuff that I find easier to understand and where I feel like my hobbies and my interests give me an information advantage over like a professional analyst.
There is no edge in holding Greg's badge. Let me disabuse you of that. It's interesting. I don't think this is the episode for it, but a couple of these points obviously are where you and I diverge. At this point, I would say borderline fundamentally, though it's not as dire maybe as that sounds, but to a large extent, the study the company price follows, in many ways, for me, it's sort of flipped. Price tells me what companies I should follow, but anyway, it's not an either or kind of thing, and it's very complicated to explain properly. But just want to note for our listeners that there are multiple ways of doing this, and in the end, it's your returns that will tell you whether the game you're playing is and the way you're playing it is working. I would just put an asterisk next to that that particular piece.
All of this is just how I operate, and this isn't how everybody should operate. It's just how I do it. It speaks to my innate comfortable place.
And if I can also, Badge, to that point, as far as I understand, since I've brought more and more technical analysis to the table over the past year and a half, what I've heard you say many times is actually not the adamant get this gobbledygook out of my face, but a more what I experience as, oh, I see that, or I see either the value of that, or I see how this aligns with X, Y, and Z. I'm just not going to weigh it as heavily as you do. I don't know if that's correct, but you've softened a little bit, yet maintain the fundamental principle.
100%. You turned me around with the options university course that you ran earlier this year. And you're absolutely right. I went from outright decrying technical analysis and saying it was total BS and mumbo jumbo. And now I recognize the error of that judgment. I now recognize it is real. You are the patterns that you technical analysis draw when you use that part of your framework do reflect some underlying reality about market sentiment, which is important. There are levels at which algos kick in and start buying stocks, or people start buying stocks. So these support levels I used to think were just garbage are real things. I just don't use them myself.
So the slogan, you got a slogan for us if we were to tie all this together? What's the Badger way of life?
Pessimists sound smart, but optimists make money. I just want to get that in, because I can sound like a pessimistic badger, but ultimately I am an optimistic Luke who believes in a good future for everybody, despite being a Palantir shareholder. And I think if you invest in that way, you might sound dumb in the short term and like this crazy optimist who is not a realist, but in the long term you win, because the world is becoming a better place. But if I had to bring this all together, know the game you're playing, stay the course, press no buttons unless you're very sure. There's my whole framework.
Nice. That's great. And with the Ryu gift to back that up, I myself I dabbled in the art of Street Fighter.
Who's your character?
I kind of like the what's it called? The Indian, the tall, the Indian guy. Yeah, that.
Yoga Flame.
Yes. Maybe we could have a Street Fighter 2 off in Warsaw.
I don't see either of the movies. There's a really bad live action Street Fighter movie with Van Damme and Kylie, who apparently were shagging on set. But there's a really good manga which I actually rewatched back in about 3 or 4 months ago. I haven't watched it for decades, and it's pretty authentic. It's a manga, like an anime, but it's pretty authentic to the characters. So worth watching.
Well, Jean-Claude is my other spirit animal. So. Anyway, no, that was great. That was a great Badge. I hope our listeners on YouTube's and Patreon's really open their ears to what you were saying, because you're getting it from the best, and there's a lot to reflect on. And it's not to say that is the only way, but our humble resident badger sure walks the walk, and so there's a lot to learn, even if you disagree or tweak some of those principles. So I hope you comment and the discussion remains open.
Awesome. Well, and thanks to Sidecar Investor for prompting the question. That was a good segment. It helped me kind of clarify my own thinking a little bit. And maybe we can get the monkey to give us his investing philosophy in a future episode if you guys ask loud enough in the YouTube comments.
Right on. Here's what I can give you, Badge. I've got a King of the Jungle stock to tell you about. I think this is one you don't really know anything about. So let's hit it. I'm gonna give you the quick overview, and then we'll go a little deeper and slower. So should you buy Amplitech? Okay, so the ticker I want to tell you about is AMPG, company called Amplitech. And here's the problem they're trying to solve, Badge. We're in the world of radio signals, microwave signals, Wi-Fi signals. And often they come in weak. And if you try to, sometimes as weak as a trillionth of a watt, if it's coming from long distances. So very faint. The whole job of the radio frequency industry is to take that signal that's a whisper, make it louder without adding extra hiss or noise to the problem. And whoever adds less noise, you could say, is the winner. But it's a complicated engineering problem. What Amplitech, AMPG, sells with a mere 46 people hanging out on Long Island is some of the quietest amplifiers in the business. Now, why am I interested in this all of a sudden? For 24 years, they basically were this mom and pop shop that sold these engineering devices in pieces, and they'd get a few $100s for each. The big people buying them would install them in their larger modules, and the company remained small. It's $150, $250 market cap, but they did fine. Now there's a major shift happening. They've advanced enough through the engineering and the patents and the licensing so that they themselves now are building the whole box of all the parts. So they're basically building the radios that go on top of the cell towers. Inside, there's 192 elements aiming dozens of beams at once instead of blasting the signals everywhere like a light bulb. So, this is in one way, this is a question of margins. Parts low margin, the whole kit and caboodle higher margins. But you might be thinking, what about Nokia, Ericsson, Samsung? Yeah, they also sell these things. However, those are foreign companies, and now we know when AI and signals are everywhere, security, privacy is a big deal, and we want American-made. Americans want American-made. Amplitech is the only American company that makes this particular kind of radio. So it's not that it's the best or the biggest, it's the only one here in America. And it took them years to get all these patents and licenses to say, hey, we got this product. So furthermore, why now? Why am I interested in this company now? It was actually AST that got me really poking around, because as I'm thinking, well, what problem is AST solving? It was a physics problem. It was an engineering problem. Can we make the signal from way out there reach telephones way down here? It's an amplification problem. So in the era of Amazon, potentially, also trying to set up a bunch of their satellites, they're going to need amplification. That's one. And two, in the age of AI, with robots and drones and self-driving cars, you need signals to arrive very, very quickly. That doesn't happen if you're going all these long distances. You need the pieces. You need these radios sitting right on the edge where the signals live, doing what they do. And so NVIDIA is sniffing around now. I put all these things together. I saw the $150 market cap, and I'm like, And I actually, in the King of the Jungle, took a rather sizable position right out up front. I bought it at 440, I believe. And within, I think 6 weeks, I'm sorry, less than that, 3 weeks, it was over 100-something%, a huge momentum play. It's since dropped down to I'm back down to a 40% gain, but that's not neither here nor there. Here's the last thing.
Sorry, let's clarify the market cap, because you keep saying $150, and that's like, our podcast is $150 market cap. So today it's a $161 million company.
Did I say dollars? Did I skip the millions? Okay, sorry. Millions. Still a baby, tiny market cap. I want to end this segment, should you buy this thing, by teasing the fact that as of a couple months ago, I think June, July, there were a lot of these industry conferences where all the radio geeks get together, and decide which way are we going. Turns out Amplitech is in the same room as the big boys from Amazon and NVIDIA. And as of recently, they allowed themselves to put NVIDIA and Amazon's logos on their own page. Now, no orders have yet been officially announced, but there has been, as one example, an NVIDIA post recently that basically says this is the technology that we want to integrate with our own GPUs for these particular purposes. No order yet. That's important to know, but it's like if it quacks like a duck and it walks like a duck, right? It might actually be a duck. And so I think in this moment, Badge, when I put all these pieces together, I see where the world is going, satellites plus AI. I see these guys have been in this business for 20-something years. They're finally increasing their margins. They're finally making all these things. They have the patents. They have the local made stamp. They have the big boys giving the stamp of approval to the tech. And it is one of these cases where it might not take long for this stock to continue re-rating much, much higher. The risk being that all of this as of now is more narrative than bird in hand, because the orders have not yet arrived. Big quarterly earnings call, I believe, is August 17th, if memory serves, and that is going to tell us whether their guidance for the increased revenue that we're predicting out of all these quasi partnerships, whether that's going to actually turn into something or not. So very excited about this one.
Cool. You say you got 42 employees. So they're like outsourced manufacturing? Is it like an NVIDIA where they design it and someone else builds it or something?
Yeah, it's a tiny mom and pop shop. And I think they've never had to scale, yet, because they've been selling these parts, and it's a relatively small market cap. So they were able to do everything. But now there is a major turning point. They're doing this series of capital raises, one actually expiring, I believe, the end of this week, which is going to dilute shareholders a bit but bring in more capital, which I'm fine with if the objective is to sell more at magnitudes more. So it's a fascinating moment, but yes, it might go from a mom and pop shop to something bigger sooner than later.
I just want to double click on the thing you said about being like American designed and built, because if we think about, say, much bigger not competitor, but another much bigger company in the same sort of industry, Huawei, like there are legitimate reasons. It's kind of, this is like a Palantir thing almost. There are legitimate reasons that you don't want like components manufactured by, essentially, air quotes, like your, quiet Cold War enemy. And if something like a radio, you could imagine that very clever engineers in this foreign country would be able to snoop on your data and exfiltrate it back to their servers. And then you've, potentially, like Huawei stuff was actually in like military technology in the UK at some point. So the UK government mandated a phase out, which is happening at the moment. So yeah, like American made is and having control of that full supply chain actually is a significant benefit. And if they're the only one, then you could well be onto something here.
Yeah, well, especially, I mean, I have an obvious counter argument right now to that. Meaning EOS, one of my major selling points was this is an American-made battery, so the U.S. is going to do everything in its hands to get out from under China's, machinations. But it's not enough. I will say though, but when you start talking about autonomous driving or anything that connects people in ways that are fundamental to their day-to-day existence, if something goes wrong with a security issue, it could be absolutely devastating. So it's sort of like maybe when you talk about cybersecurity, the risk of not having the proper cybersecurity or the proper have done your due diligence is too great. So you're going to default to doing it the right way. And so if that means American made in this case, then Amplitech is going to benefit greatly from that.
And if we just lean into the self-driving cars thing, like just to make it really clear, like we have a ton of BYD cars, which are Chinese manufactured in the UK and I guess in Europe. You don't have them in the US. And, it's not about some like crazy, actual war breaks out and these BYD cars start running down like civilians. It's not about that. But essentially these cars are like a massive sensor suite with like cameras all around them, collecting vision data like 24/7, even when they're parked, like my Tesla in Sentry mode, it's still recording what's going around it. So, you can imagine if we don't have the right controls, then essentially China have millions of roaming cameras in our capital cities, and they can stitch all that data together with AI, and they can monitor, what everyone's doing. Maybe there's even microphones on board. They can eavesdrop on conversations. So, that's the nature of the threat that is real.
Yeah, very, very much so. I mean, in putting our AST hats on, if you're talking about signals now, all of a sudden they're everywhere at all time. I'm no engineer, but I would imagine you want to take every last step to ensure the integrity of that signal is not being compromised. And obviously radio engineering is one of the key components to the whole, how it all works. So yeah, to answer my own question and finish the segment, I believe investors should buy Amplitech. This, of course, not being financial advice.
Awesome. Very good. Well, I'm glad we sort of got into security there, because I'm going to talk about Palantir, and that's like their wheelhouse. Should we get onto that one?
Yeah, help me unconfuse myself. I remain absolutely confounded by this company after all these years.
I think I understand what Palantir do, but I want to start off with just, we are doing like the social media thing, so I want to keep it super simple, and I'll just give you like a headline overview. But if you've got time and you'll kind of be gracious, I would like to loop back and get into a bit more on what Palantir really does, what these software products really do. Because I think it's quite important to understand. And then eventually you understand why I think this is a company making the world a better place. Like controversial. So Palantir, ticker PLTR. So every big organization, might be an army, might be a bank, might be a car manufacturer, might be like an emergency program rolling out COVID vaccines. They're all sitting on massive amounts of data, but the data is a total mess. If you're an old organization, it's scattered across dozens, maybe hundreds of different systems. They don't talk to each other. The data's in different formats, owned by different teams. And so if you want to, at the top of a company, ask like a simple question, like where are our vehicles right now and which one needs parts, no one can really answer it because it's in like 15 different places at once. So Palantir's whole business is about turning that chaos and mess into something a business can actually act on. And they do that through 3 products. I'm just going to give you the headlines, but if you come back and listen to the full episode, I'll go into a bit more detail. You've got Gotham, which is their defense and intelligence platform. So that's like military. You've got Foundry, which is the commercial data platform. So that's like similar to Gotham, a bit different, but for business. And then really the new layer that sits across both of those, which is what everyone's talking about right now, is AIP, Artificial Intelligence Platform. And AIP at a very high level allows you, a company, to use AI like Claude and ChatGPT and things like that, but to use it in a safe manner. And I'll come back and explain what safe means. Incredible numbers. So it's government and commercial. And on this picture, it's a stacked bar. The green bar is the government revenue. The blue bar is the commercial revenue. And you can see that just visually, you can see they're both growing at an incredible rate for a big, mature company. And I've got some little line charts on there. If you can't read the details, essentially, government revenue grew 76% year over year in the most recent quarter, March. And commercial revenue grew 95% year over year. So like commercials becoming bigger and bigger. So that's incredible growth, which makes Palantir, is a growth stock. It makes it an expensive company. Like, it is expensive. Here we're looking at enterprise value to free cash flow, because I think that as a metric like weeds out a lot of nonsense to do with like stock-based comp and things like that. But the reality is Palantir is trading for 113 times, 113 times free cash flow today. And I just want to put that in context. So I don't know if you still use that website, Meritech Capital. Great website, meritechanalytics.com. So they track about 200 different tech companies. And here's an extract from Meritech. If you look at all the companies they track, like a couple of hundred of the highest flying tech companies in the world, and you sort by like pretty much any valuation metric, Palantir is like right at the top of the list. So here's an extract where I've sorted by enterprise value to annual recurring revenue, and Palantir is like 45 times ARR. And if you go down, it made me laugh actually, because I consider myself, a growth investor, but I try and stay away from like really crazy stuff. Like if the top 10 most egregiously valued companies in the world, I own 5 of them. You probably own a few. Like if you're not on the YouTubes, in order: Palantir, number 1, Cloudflare, CrowdStrike, AppLovin, Palo Alto Networks, Datadog, JFrog, Snowflake, Axon, and DigitalOcean. Like in general, by most valuation metrics, they're the 10 most expensive companies in the world. So yeah, not great owning half of them. So bear case on this, I think it's an incredible product. Bear case on Palantir is valuation. It's very expensive. Arguably, the company could have 10 years of 95% growth and the stock price could go nowhere because it's got to grow into that valuation. So there we go. I'll give you a chance to jump in.
Yeah, that all makes sense, Badge. Here's maybe I want to return to the elephant in the room, is at least in months past, many people have an ethical aversion to this company. Now, here's my honest, in the moment understanding of why that is. When you have a platform this powerful, congregating a bunch of data and having AI make sense of it, you could point it in whatever direction you want. And if it's sitting in the office of, if it's in the hands of a villain, it's going to do villainous things with that data. So my understanding is almost like, correct me where I'm wrong with this, the technology itself is neutral. It's incredibly powerful and it could be used for all kinds of things. But the initial days of the way the government was using it, some people found it politically, ethically suspicious. They were targeting certain people for political reasons. Is that the case? Is that how you understand this? That there's going to be bad use cases, but also potentially good ones, and it's up to you to decide?
Yes, that is. Like it's if we think about just the military applications, so like Gotham plus AIP, it's an incredibly powerful software weapon. Yep, 100%. and it's used to, it can be like any weapon, like a gun or a nuclear bomb. It can be used perhaps for good purposes and for bad. Well, maybe argue about good purposes for nuclear weapon, other than as a massive deterrent, which might prevent like escalation. But like anything, what do the Second Amendment guys say? Blame the shooter, not the gun, or whatever. I don't know. Maybe I made that. But yes, like any weapon, you can use it for good or for evil, and as Peter Parker's grandpa said, like with great power comes great responsibility. So I think it's good that the West has tools like this. And I prefer that they're in the hands of like Americans rather than the Chinese, for example. But at the same time, it's not inconsistent to say, I wish that the West had like very strong controls and regulation and governance and oversight of the use of these tools, so that they're not used for like mass surveillance and like very bad social outcomes. And I think they are in cases, although Alex Karp, the CEO and founder, would decry, I'm guessing that it is being used in somewhat nefarious ways by different organizations around the world.
Yeah, and here we bump very quickly into my no holy place to stand, because if I take something as simple as the iPhone, or it's not as simple, but it's now everywhere, I could easily argue that this device has created a whole generation of young addicts with deeply compromised attention spans, high depression rates, high, increasing anxiety and suicide rates, social isolation, and so forth. Therefore, iPhones and Apple is an evil company, or Meta, or pick your, fill in the blank. But I think that's just not how the world works. Like, I mean, it's true, and it's, the decision point ultimately lays in some other layer, and we have to accept the complexity with these things. Otherwise, I guess you could say, I'm only going to invest in companies that are political, outright politically aligned with your views, but I think that's a whole different ballgame.
It comes back to me saying at the top of the episode, I'm an optimist ultimately. Like, I see the benefit of tools like this in military and in commercial side of things. Like, a great example was Palantir was used during Operation Warp Speed, I think that was the name of it, where the US had to get like tens of millions of vaccinations, hundreds of millions of vaccinations into arms. And like, you've got this monstrously complicated supply chain from drug manufacture to shipping and logistics and keeping the drugs chilled and then getting them into, hospitals and surgeries and pharmacies and then getting people injected. And like, Palantir enabled that to a very significant degree. So I think, although we might look back at the vaccinations and go, well, maybe that wasn't actually the right thing to do as a society, we thought that was the right thing to do at the time, and Palantir helped us do it, helped us achieve what we believed was a good outcome. And in business, like, if you'll give me like 1 or 2 minutes, I do just want to go down the rabbit hole a tiny bit, just to kind of explain what these things are. Because we've talked about Palantir, but I'm sure there's still a ton of people listening, and maybe you, who still don't really understand what these tools actually do. So let me just bring that to life quickly. So, and we'll talk about, let's get away from like the controversy of military. Let's just focus on Foundry and commercial. So, you've got like a factory and you're trying to manufacture widgets, and you've got a complex supply chain, and maybe you have bought other factories and you've got, this monstrous mess of data. Well, when Palantir come in with their consultants, this isn't like a pure software SaaS business. There is like a consulting element. They help you develop what's called an ontology, which is like, it's kind of like the architecture of your business, like the shape of your business. We sell these 200 different products and we have these 300 different inputs, and we've got these different people with like all these HRE kind of attributes, and we've got, factories and loans and supplier and customer relationships, this mess of stuff. So they help you define your ontology, and then once you've defined that, Palantir is a very fast, efficient way of then looking for relationships in that data and then trying to essentially like optimize, look for bottlenecks in your process, ask questions about the organization, and just make your organization more efficient, which is good for your business and ultimately shareholders of your business if you're a public company. So that's kind of very high level what Foundry does. And then AIP, which is like this layer that sits across Foundry and Gotham, what that does is, like, if you're a business and you've got commercially sensitive data, you can't just have your employees like, chucking stuff into Claude or into Gemini or ChatGPT to develop, here's I know, like the minutes of the last 10 meetings, help me like develop the action points or something, or help me build a project plan for this or whatever. Or, marketing, here's our corporate strategy, product roadmap for the next 5 years, develop a marketing campaign. If you chuck all that stuff at Claude, then Claude is gonna ingest that. It will become part of the model, and then it might get leaked to your competitors. So you just can't do that as a company. So what companies end up doing is they end up sort of self-hosting their own AI models, like versions of these leading models, but that's expensive and it's complicated. So what AIP does, it allows companies to use best-in-class AI models, but use them in a safe way. So your data is ring-fenced and it's not going to leak. So if not just like having data, but making decisions. So, like you've built a whole load of stuff for the podcast, which takes like inputs and actually does stuff like creates videos for YouTube and things like that. It does a real thing, which to us has commercial value. Well, if you're a big organization, maybe you want your AI to make like supply chain decisions. And so having AIP as a layer in there lets you monitor, control those decisions. So you say, okay, the AI can only make a decision up to $100,000 in like costs or something, or only a decision in these certain areas. It lets you ring fence the data the AI can look at. So maybe there's some stuff that's so super confidential, you want to kind of exclude that. And it also lets you audit. So if something happened, that it was like this human and this bit of AI that saw this information and made this decision, and you can evidence it, because you have to be able to kind of audit what happened. Or you might get asked by a regulator, but if nothing else, you want to kind of improve your processes and monitor your organization. So it's kind of that. It's like essentially use AI safely in a controlled manner within your company. That's what AIP is. And that's why Palantir is pretty important in the age of AI.
Give me a 2-sentence reply. Should our listeners buy Palantir today?
Probably no, because of the controversy, and it's expensive. But I own it. Smallish allocation, 1% allocation. I want exposure to this, and I'm reconciled personally with the idea that Palantir makes the world a safer place. And to me, safer equals better.
Okay, bravo. Badge, before we close, shall we thank our friends at Fiscal AI? Because you showed us a fancy chart. You used Fiscal AI, as we always do, and it's just where we start our research. 20 years of global financial data, just a whole bunch of KPI data sets that are specific to particular companies that you could really fine-tune your research, like Oracle's backlog or Duolingo's daily active users, earnings calls, transcripts, ownership data, research reports. It's all right there. Use our link fiscal.ai/wildlife for your first week of Fiscal Pro free and a 15% discount if you upgrade. That's fiscal.ai/wildlife.
Krzysztof, are you ready to become a beast of an investor?
Never been more ready, Badge. Our journey, your journey, our journey, everyone's journey starts right here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.